You don't pay council tax yourself if you rent out your property, but still probably you can't push the rent too high yourself because the renters, the occupiers, needs also to deal with increasing council tax bills. And if you own your property via a limited company, also the corporation tax rate has been, after the COVID years, increased to 25%.
In this episode, we're going to talk about one of the aspects that most people underestimate when buying property in the UK, taxation. We will discuss how the tax landscape for landlords has changed over the past decade, the key differences between buying a property personally or through a limited company, what happens if you move abroad while still owning property in the UK, and how capital gain tax actually works when a property is sold. My guest today is Andrea Manzini, tax specialist, chartered accountant, and chartered certified accountant. Andrea, welcome. Let me start with a simple question. When someone wants to buy a property in the UK, what are the main and most important aspects they should look at from the very beginning?
Hi, Francesco, and thanks for inviting me. So, to answer your question, there are several factors that needs to be considered when someone buys residential property as an individual. I'm going to name a few, probably it won't be an exhaustive list, but this includes, first of all, whether you are buying a property for yourself to live in or with a view to rent it out, hence as a buy-to-let property. Then you need to consider if it's a buy-to-let property, where you are resident, whether you are a UK resident or resident overseas. There's also the aspect of the whether you're going to buy the property cash or with a mortgage, because there are finance costs and several tax implications that needs to be considered when there are finance costs involved. Another aspect is whether you are planning to buy a property as an individual as opposed to through a limited company, for instance, and are planning to, even if you decide to rent it out for a certain period of time, whether you then can consider living in the property for a certain period of time, because that has implication when you sell your property. Now, the taxes that are affected that needs to be taken into account when there's residential property transactions. First of all, the first one is stamp duty land tax or SDLT. If you buy a property for yourself and that's your first property, the SDLT bill tends to be not huge, not as big as when you buy a second property with a view to make a profit out of it and getting some rental income. Because in that instance, you'll be paying the higher rates of SDLT, so an additional 5% surcharge. Let's make an example. So if you buy a property to live in as a first-time buyer, and the property is the purchase price is £500,000, the SDLT bill, if you are a first-time buyer, so you have never had, you never owned a property, and that's your first one, it's £10,000 currently. However, if it's a second property and is a buy-to-let property, the bill rises to £40,000. That's the effect of
there
the...
is a surcharge,
There's the surcharge, this 5% surcharge. Now, if the property is not if as a result of the acquisition of the property, that's going to be your sole property, because at the same time you sold another one, the SDLT bill is £15,000 because you're not classed anymore as a first-time buyer. First-time buyers have special lower rates and relief, providing that the property is cost less than £500,000. Now, there's another aspect to consider with regards to the SDLT that some people tend to overlook, which is your personal circumstances, so your marital status. So if you're married or not, effectively. Let's make an example just to provide some clarity around this. Let's say we got a couple, let's call them A and B. The married couple, they both own a property. A owns a property and rents it out. B owns a property and lives in this property with his or her partner, spouse. They decide to buy a new property. Let's say they live in a flat, they want to upsize, they want to buy a house. So they buy a house, and at the same time, they jointly purchase this house and they sell the flat where they live in. So B sells her flat, essentially. Now, although for A that's a second property, still they don't need to pay the higher rates of stamp duty land tax, because that's counted as a replacement of their main residence. However, in the same situation, so let's say that they buy this property for £500,000, £500,000, their stamp duty land tax for them, joint new owner of the house, will be £15,000. End in the exact same situation, if A and B were not married, they would end up paying £40,000, because the acquisition of the house would not count as a replacement of the main residence for A, who already owns a buy-to-let property. Two similar situations, almost identical, but the SDLT bill is actually £25,000 more for the unmarried couple as opposed to the married couple. So again, that's another, your personal circumstances also needs to be taken into account, and that's one of the tax aspects that you need to factor in. Then, of course, if you live in your property, you go council tax. Yeah. If you don't, that's normally paid by the occupiers, so the renters in this case. We touched on capital gains tax. If you live in the property and you live in the property up until to the point where you sell it, you are exempt from capital gains tax, assuming that you're going to make a gain out of the sale of the property. I mentioned finance costs. Now, if you buy a property with a view to as a form of rental business, and you buy as an individual, from 2017, there's no longer full deductibility of your finance costs. So if you have a mortgage, the interest of the mortgage are no longer fully deductible for income tax purposes. So you get an income out of your buy-to-let property. However, you cannot deduct from your taxable rental income your finance cost, the interest on the mortgage. You get a tax benefit, a tax credit, effectively.
Technically, tax relief, I guess.
A tax relief, yes. But if you are a higher rate taxpayer, the tax relief is capped at 20% in the best case scenario, because that's the best case scenario, because there are other situations where you get even less than 20%. But normally, let's say in most situations, you get this 20%. But if you're high rate taxpayers, meaning that you're paying 40% income tax, so you're an additional rate taxpayer, so you're paying 45% income tax because you have other incomes, for example, self-employment income or employment income up to at least £50,270, you become a high rate taxpayer, so the rental income get taxed at 40%. However, you don't get the full deductibility at 40%. You only get the marginal
so
relief.
There is basically a cap on
There's a cap.
what you can deduct for higher tax rate payers.
And that actually affects quite a bit the effective tax rate. Let's use an example. So if your rental income is £1,000 per month and you get mortgage interest of £500 monthly, mortgage interest of £500, let's exclude any other cost that may or may not be deductible for income tax purposes. So that means that your net rental income is £500, right? Now, and let's assume that you are a higher rate taxpayer. So you get taxed at 40%, by the way, soon to be 42% from 6th of April 2027. Mm-hmm. But at present, 40% still. So you get taxed 40% on the £1,000, not on the 500, on the net rental income. That means that your income tax liability is per month is £400, right? Now, you also get a deduction, which is the 20% of your finance cost, mortgage interest, £500, 20% is 100. So you can deduct this 100 from the £400. So you end up paying £300 in income tax. Now, that's a marginal tax rate of 60%, because remember, your net rental income is £500. So 300 on £500 is actually 60%. So that's huge. That's massive. And that's something that should not be overlooked, particularly if you are a high rate taxpayer and you are highly geared, so you got a sizable debt on your property.
So this is an interesting overview, and so one of the questions that comes up, especially for investors, so
yes.
For example, buy-to-let investors, let's say, is whether it would be probably more convenient to purchase a property, a rental property, so an investment property, as a company rather than personally. So how do you think, what are the pros and cons of this, and how do you think investors should actually approach this?
The first thing to say is that you should first of all take into account non-tax considerations, because when you decide to incorporate, so to create a limited company for your residential property rental business, incorporating a company has costs for sure, and has a set of implications that you need to be aware of,
and liabilities as well.
And liabilities, of course.
You're going to be director of a limited company,
and that comes with, I guess, pros and cons.
Yeah.
Yes. You have a big responsibility if you are a director of a limited company, and you got obligations as well that comes with it. There's a sizable admin burden to deal with that you would not normally have if you buy one or more properties as an individual as opposed to a limited company. And also, one thing that some people tend to overlook every now and then is that it's the company that owns the property. It's not you as shareholders, even if you own 100% of the limited company, which in turn owns the property. So the property as an asset is owned by the limited company. Again, pros and cons. That means that any any debt related to your rental business, essentially, is for the company to deal with, which is separate from your personal assets. Any legal dispute that may arise as a result of this business is for the company as a legal person in principle to deal with, because there's this thing, this legal concept, which is called veil of incorporation. Now, the veil of incorporation, which essentially means that there's the incorporating a company creates effectively a separation between the assets and liabilities of the shareholders and the assets and liabilities of the company. However, this veil of incorporation is probably worth mentioning that it can, in very rare or exceptional circumstances, such as fraud, for instance, be lifted. Yeah. Hence, you, as a director and shareholder, potentially could become liable for the debts of the company. Then, obviously, the creation of a limited company for some people also enhance the appearance of professionalism of the business and of the directors as well. And another aspect, again, non-tax related, that should be taken into account very seriously, I'd say, is the fact that normally, as you might be aware, and some of our viewers as well might be aware, if there's any debt it's entered into by the company to purchase the property, the interest on the debt tend to be higher, if not much higher, for a limited company as opposed to an individual.
From my experience, it's usually 1.5% more than, On a property, we pay 6.25% on a buy-to-let property. Yeah.
So there you go. So those are the non-tax consideration. And then, of course, there are the tax implications of owning a rental business as via a limited company. So let's start from stamp duty land tax again. Stamp duty land tax, usually if it's a rental property business, is subject to the higher rates. That means, again, that 5% surcharge that you will be subject to if you buy a second property and is not a replacement of your main residency, then that is applicable to a purchase of a residential property by a limited company. Let's keep in mind the sort of £500,000 property that I mentioned before. That means £40,000. So if you're a first-time buyer and you buy a property as an individual, you would only incur £1,000. The first property by a company incurs a stamp duty land tax of £40,000, assuming that the purchase price is £500,000. Yeah. That's quite a big difference.
Yeah, but it is probably rare then that a person is gonna buy their.
It's quite rare.
Their own first and only property
via a limited company to live in.
Anyway, yeah.
Then, beyond the stamp duty land tax, there's another tax which is very specific for the acquisition of residential property as opposed to other type of property, so that excludes, for example, hotels or care home, etc. So residential properties, if the price is over, if the value of the property is over £500,000, there's this ATED, annual tax on enveloped dwellings, which is an annual tax based on the band in the band in which the property falls into, depending on the value of the property. Yeah. So,
to give an example,
yes, lower than £500,000, nothing to pay. Between £500,000 and £1 million is, I can't quite remember whether it's already or from this April will be 4,900, so close to £5,000 payable annually. If it's between 1 million and £2 million, that the ATED bill rises to close to £10,000, and then it surges to over £30,000 and more for properties value more than £2 million.
Yeah.
Now, the real important point here is valuation. It's not a one-off exercise, but it's something that you need to keep doing and revaluing the property for the purpose of this tax.
Yes, and it's worth mentioning that this tax is not due if the property is rented out.
Yes. Again, it's only applicable in principle to residential properties.
Yeah.
So, as I said, other type of properties could be hotels or care homes are excluded from this tax. Then there's, as opposed to income tax, there's corporation tax. Corporation tax to pay on the rental income generated by the property. Now, corporation tax rates are for small profits up to £50,000. The applicable rate is 19%. Over £250,000 is 25%. So, if you compare that to the 40%, soon to be 42% payable by an higher rate taxpayer, obviously that sounds attractive.
Yeah, but then the money is owned by the company.
But then the money is an asset of the company, it's cash on the company. Now, if your view is then to reinvest that money net of taxes, of the corporation tax, let's say even if it's the 25% that is applicable to your rental profit, there's no other taxes effectively on the income to think about as a shareholder. You would be reinvesting your retained earnings effectively of the company. However, if you decide to extract some of these profits, then there's taxes on dividends. And the taxes on dividends have recently been increased, the basic and the higher rate for basic and high rate taxpayers, just over 10% and just over 35%. If you are additional rate taxpayer, you pay close to, I just go by memory, and memory may fail me, but I think between 39 and 40%. So again, that's an additional tax if you want to tap into the cash which is owned by the company. There's no capital gains tax for the limited company to pay. But when you sell, if you sell for a gain, of course, then the gain is subject to corporation tax. Again, the 25%. Now, the capital gains tax, there are two rates now, 18 and 24%. So that's lower compared to the 25%, if it's 25% as opposed to 19% for small profits payable by a company in terms of corporation tax. However, I've mentioned the 40, soon to be 42%, or 45 if you're an additional rate taxpayer, soon to be 47% in terms of income tax rates applicable to high income individuals. Then we can debate whether somebody owning just over £50,000 is a high income individual, but nonetheless, those are the rates. However, let's not forget that because of the non-full deductibility of interest on the mortgage, that's 42%, at present 40% for a higher rate taxpayer. Turns out, in the example that I mentioned before, to be 60%. So then you compare the 60 with the 25 plus the dividend tax. It's a fairly complex sort of analysis and calculation to be carried out, which again depends very much on your circumstances, whether you got a mortgage or not, and whether you are a higher rate taxpayer or not, whether you expect to be an high rate taxpayer or additional rate taxpayer going forward. How long are you expecting to keep your property for? The bottom line is that essentially, and I keep stressing this, but I think it's very important, the more complex your personal circumstances are, the higher are the numbers of properties concerned, whether you have properties also overseas, whether you are a UK resident or not, all of this needs to be taken into account to then assess and evaluate what the total tax income could be one way or another, without, as I said, forgetting about all the other very important non-tax consideration that should drive in the first instance the decision whether to incorporate or not.
Yes. So over the past years, probably more and more people, investors, I would say, have decided to go to purchase properties under a limited company. But what is the trend in terms of how spread is this?
There's, I think it was mid last year that HMRC published a research which commissioned, I think, to Ipsos. And some of the findings were quite surprising. For instance, despite recently there's been an increase in the number of rental property business being incorporated and managed and owned via a limited company, still 93% of all landlords in the United Kingdom own at least one of their property within their portfolio as private individuals. So this is still the most widespread and commonly used way to own buy-to-let property, 93%. There are other couple of findings which are quite enlightening, I think. One of these is that 1 in 3 landlords expect to sell at least one of their properties within their portfolio within the next 5 years. And 20%, so 1 in 5, would like to sell at least one property or divest completely from the market, 1 in 5, within 12 months. And one of the main reasons, if I remember correctly, perhaps the main reason was taxes, tax rules changes. And there's also the MTD, the making tax digital obligations for landlords coming on the market that landlords needs to comply with.
So if we compare today's situation to the one of, say, 10 years ago,
yes,
we can say that the landscape for landlords has changed quite significantly.
Dramatically.
What actually happened, and what do you think we can expect?
Well, let's think about, if we think what were the tax costs that a landlord should have expected back in 2016, 10 years ago, in fact. Well, overall, they were much lower. Again, let's start from stamp duty land tax once more, which is the first tax that you deal with when you complete a purchase of a residential property. And there were no high rates of stamp duty land tax. And by the way, the 5% surcharge that we discussed earlier used to be just a few years ago 3%. That has been increased to 5%. But in 2016, it wasn't a thing. So let's use another example. The average property price in the United Kingdom as of December 2025 for the whole of the country was, I think, £293,000. So let's use that as a reference. That's the average price. So a property bought for £293,000 back in 2016 had an SDLT bill, even if it was the second, the third property, of just over £4,500. Now, the same property bought by a landlord who already owns another or more properties with a view to rent it out, of course, now triggers a SDLT liability just short of £20,000. So that's over £15,000 more, and that's SDLT alone. Then there's the impact on the income tax. 10 years ago, mortgage interest fully deductible, in full, regardless of whether you were a high rate taxpayer, additional rate taxpayer. Now, again, the restriction that we talked about, which has the effect of pushing the marginal tax rate, income tax rate, up to 60%.
Yeah, and if you add up the fact that interest rate has
of course, tripled compared to that
5 years, that's another layer.
That adds another layer of cost, not strictly speaking tax cost, but still it's a consequent tax cost that wasn't there 10 years ago. Yeah. We can also discuss about council tax rises, which has the effect, of course, you don't pay council tax yourself if you rent out your property, but still probably you can't push the rent too high yourself, because the renters, the occupiers, needs also to deal with increasing council tax bills. And if you own your property via a limited company, also the corporation tax rate has been, after the COVID years, increased to 25%. And also the ATED that we discussed, so the annual tax on enveloped dwellings, I think when it's been introduced, and I think it was back in 2013, was only applicable to properties with a market value of at least £2 million. Then, of course, again, as I mentioned, 2027, from April 2027, the income tax rate applicable to landlords at basic, high rate, and additional will be increased by 2%. So it'll be 22%, 42%, and 47% compared to the 20, 40, 45 that are now in force. Has been a gradual but steady and continuous trend of tax rises for landlords, and hence the findings of the study by HMRC are not surprising at all.
Yeah. And I would say also moving abroad sometimes cannot solve the problem because another situation that is usually overlooked is, so say you own a property in the UK and then you move abroad. Well, you might incur in local taxes that apply to your UK property.
That's true. And I can actually mention one example which has the potential to drive a sell-off of UK properties by people who decide to relocate overseas, in Italy in particular. And that's because once you become Italian resident, you are subject to a wealth tax, which is called IVIE. That's the acronym, which stands for Imposta sul valore degli immobili all'estero. So a tax on the value of the properties which are located outside the Italian territories, effectively. Yeah. Now, the applicable tax rate currently has just been increased to 1.06%. And you may say, well, it's not much. But it's on the value of the property. And here's the trick. If the property in question is based within the European Union. You apply that 1.06% to the value of the property which is used by the government or the state in question for the purpose of calculating other local taxes.
So, for example, in the UK, it was the value used for calculating the council tax.
The council tax.
Now band rates, and
correct.
It was like 1/10 of the actual usual like value of the property. So
correct.
It was a huge difference. Yeah.
It's a huge difference because if you use the property based in the United Kingdom up to 1st of January 2021, so pre-Brexit, you would be using for the purpose of calculating this Italian wealth tax on property located abroad, the council tax value, which, because the council tax property values have not been updated since 1991, this value tends to be extremely low and very much out of date. So let's say that it is possible that if you own a property in London that you recently purchased and you paid, let's say, £1 million for it, it could well be that the actual council tax property value is £100,000. So pre-Brexit, you would have applied this 1.06% to £100,000. The effect will be just over £1,000 of IVE liability payable to the Italian government, to the Italian tax authorities. However, post-Brexit, because the property is located in the United Kingdom, which is a non-European Union country, hence the property is classed as non-European Union property, you need to apply the 1.06% to the lower of the purchase price of the property or the market value. So if you recently purchased a property for £1 million and is now worth just over £1 million, you would apply the 1.06% to £1 million. So from £1,000, suddenly you pay £10,000 just because of Brexit. When you relocate abroad, you need to consider all these tax implications and get a proper tax advice, because you could easily overlook this situation. And actually, if you think about it, even if you have lived in this property, London property that I mentioned, million pound property, and you have a view not to sell it but to rent it out, and then you want to retire in Italy, well, actually, those additional £10,000 could actually flip your position into negative cash flow. Yeah. So you'd be perhaps better off selling the property.
Let us now talk about capital gain tax, which is applicable once you sell a property.
Yes.
So how does this work in the residential property environment?
So capital gains tax, as I said earlier, is applicable to on gains made by those owning a property as individuals. The gains when there's a sale made by a company are subject to corporation tax. Now, there are two rates currently, which are 18 and 25%. 18 if you're a basic rate of payers, otherwise it's 24%. Now, where do you apply this 24%? The 24% is applicable to the difference between the purchase price plus any additional and directly related cost that's been incurred when you purchase the property, legal fees, for instance, or actually the stamp duty land tax as well. So you add up all of this, and that's your total purchase price for the purpose of capital gains tax. And then you got a sale price. Okay, so let's say you bought a property for £500,000. You incur a legal fee of £10,000 and stamp duty land tax of £15,000. So £5,225 is your starting point. You have sold it for £625,000. So your gains on the property is £100,000. Okay. on that £100,000, depending whether you are a basic rate taxpayer or not, you need to apply the 18 or 24%. So if you are a high rate taxpayer, 24%, that will mean a capital gains tax liability of £24,000. However, there's one thing called the annual exempt amount, which again has been reduced quite substantially over the year. Used to be £12,000. That's been reduced, cut in half to £6,000, and then 50% less again to £3,000. So now it's only £3,000. And by the way, that is applicable to all gains that you make. So if you sell shares or other chargeable gains, so it's not enjoyed solely by the gains made on the sale of residential property. So let's assume that you got that £3,000 still available. So you deduct that £3,000 from the £100,000, and then you apply the 24% on the net amount as a result. Capital gains tax as well, the rates have been recently increased. However, I'm saying they've been recently increased, but I think, I'm just going by memory, I think for residential properties, probably they've always been 18 and 24%. But actually, I wouldn't be surprised if at some point, also for residential property, they will be bumped up again. One more thing I'd like to add on this subject, which is, again, I'm going back to your marital status, whether you are married or not. Because if, let's say that you have used all your annual exempt amount, those £3,000 that I mentioned earlier, but your spouse, wife or husband, has not. Now, in theory, you could first transfer the property, sell effectively the property over to your spouse, and that is a no gain, no loss transaction. So there wouldn't be any capital gains tax to pay on that disposal to your spouse. And then your spouse can in turn sell the property to the third party, making that gain, well, assuming it's a gain, and can use the £3,000 annual exempt amount. So even if you have already used your annual exempt amount because of other gains on other disposals, and your spouse has not, then potentially you can tap into that and obtain that tax advantage, essentially. Now, the only caveat here is that you need to trust your spouse not to run away with the milkman, essentially, because you would make initially a disposal in favor of your spouse, and no gain, no loss, and then he or she in turn would sell the property to the third party.
That's interesting. We can see how probably many times like decisions on property investments are really much driven by tax implications rather than property fundamentals itself. This is quite, it's not surprising, but it's really, really important. And whether you are buying a property as an investment or even you have to consider these implications even when you decide to buy a property for living, because sometimes it can be even better to go and rent in specific market conditions. What do you think is the trend now and future with property taxes in the UK?
I think we got to a point where the complexities are so many, and the tax legislation has evolved in a way whereby it's not as easy to assess your situation from a tax point of view, that the more complex is your situation, your affairs, the number of assets you got, your personal circumstances again, the more you need to get proper tax advice. The same when it's the same principle that is applicable when you want to buy, for example, a hotel, for instance. You would, and you have no expertise in that sector, you would rely on somebody, property experts like yourself, for instance, that can provide that advice, the level of expertise that can guide you through the complexities of certain transactions. Same when you need to deal with the legal aspects of certain transactions. Now, the sort of tax DIY, if your situation is particularly complex, is particularly complicated, essentially, is not recommendable. And we have seen at least one example recently, and I'm referring to the former Deputy Prime Minister, that actually is no longer a deputy Prime Minister because she had an issue in relation to stamp duty land tax. Now, her situation was fairly complex. And for the record, I do believe that she acted in good faith, that she made a genuine mistake, and she was not intending to make any mistake. But let's remind ourselves why she's no longer a member of the cabinet of the current government. And it's because she did not get a tax advice for her residential property transaction. She wanted to buy, and she bought, I think, a seaside flat somewhere, I think, in Brighton or close to Brighton. However, her situation was fairly complex, with the disposal of another property in favor of a trust whose beneficiary was her son, who was underage. I think he was 17. And when she completed the purchase of her new property, and as a result, that property transaction that she entered into was not subject to the standard rates of stamp duty land tax, but the higher rates, because by virtue of that trust in the name of her son, and her being a parent, she was then the deemed owner of the property that she disposed of for stamp duty land tax purposes. And again, she ultimately resigned effectively from her position as Deputy Prime Minister, not because she made a mistake. I mean, apparently she did, but she did not get a specialist tax advice, which she did then in retrospect to rectify her position. In fact, the findings of the ethic advisor of the government was that she fell short of the government ministerial standards because she did not get a tax advice. So that's probably highlight the importance in this tax landscape on property transaction that got so complex, with so many scenarios, rates, loopholes, that getting a tax expert to advise you on, simple things as how to be tax compliant can be absolutely crucial.
Yeah, say for example, for stamp duty land tax, I rarely see people seeking tax advice for that. While sometimes they can even save some money because
of course,
discounts and exceptions.
I mean, in certain situations, the sort of transactions and circumstances are fairly straightforward. I mean, if you're a first-time buyer, it's obvious that you only pay. And people tend to rely on the solicitors or conveyancers that actually help them with the legal side of things, and then often more often than not, in fact, submit then the SDLT returns on behalf of the on behalf of that person or people that decide to buy a property. But if your affair and your situations is not straightforward, well, then I think getting a tax advice can ultimately save you money.
Yeah.
Although it might be expensive.
And avoid risks as well.
And avoid risks, and of course penalties and interest, and sometimes also save your reputation.
Yeah. Okay, Andrea, thank you very much for this and for sharing your insights, and thanks for coming to the podcast.
Thank you very much. Thank you.
If you are interested in understanding how real estate investments actually work, from acquisition to structuring and asset management, consider subscribing to the channel for more conversations like this.